Well, I think if they don't cut rates in September, the markets may not like that because they're pretty much pricing in a cut, which is why I expect the cut to happen. The question is, are they going to go 25 basis points, 50 basis points? That's kind of where we are. But the broader point is that they shouldn't be cutting rates at all. In fact, not only should they not be cutting rates, they should be raising rates. They stopped raising rates too soon. Monetary policy never really became restrictive the way they claim. And the reduction that we've had in the official measures of inflation is only temporary. And I think that these rate cuts that are contemplated and will probably start in September will be the catalyst to cause inflation to rise to new highs, at least the way it's measured by the CPI. You know, the Fed claims that it's data dependent. Well, the most important data point when it comes to monetary policy and whether you're too loose or too easy is gold. And in fact, Alan Greenspan, who used to be the Fed chairman, when he was asked about it, he said that he uses gold. And at the time, gold was around $350 an ounce when he was answering this question before Congress. And he said, well, if I see the gold price up about 400, I know that I'm too easy. And if the gold price goes below 300, I know that I'm too tight. So he said, we're not officially on a gold standard, but unofficially we are, because I use gold as a guiding, a light to set policy. So I know if we're too easy or too tight. Well, by that, data point, gold's at 2,500. Gold's at an all-time record high. Gold's moved up 25% so far this calendar year in anticipation of the Fed cutting rates. Well, what does that tell you? That these rate cuts are a mistake. That is the data point that the Fed should be looking at. Also look at the dollar, which hit a new 2024 low this week. It's now back to where it was in December of 2023. But what's more important is the trajectory. The dollar is falling, and it looks like it could fall substantially. Again, this is the currency market saying you're making a mistake, because the weak dollar in and of itself is going to push up consumer prices because we buy stuff with dollars. America has $1 trillion a year trade deficit. We import all sorts of products that we pay for with dollars. Well, if the dollar goes down, the price of all those products has to go up by definition. So the Fed is about to make the inflation problem worse by claiming that it solved it. Right? So they're actually not cutting rates because they won the inflation war. They're cutting rates because they lost. It's a surrender, because they're looking at the impact that the higher interest rates are having on the economy, on employment, which is something that has to happen, because the low interest rates is the artificial support that boosted the economy. It created based on debt. And so when you raise interest rates, you make that debt that was accumulated when rates are low a big burden on the economy. So there's no way to normalize interest rates without collapsing the artificial economy that was built on top of the cheap money. But now the Fed doesn't want that to collapse, so it has to go back to the cheap money, which means we're going to get a lot more inflation.
As Peter Schiff has been warning for years, the U.S. economy is teetering on the brink of a new and severe inflationary crisis. While the markets and media remain focused on the short-term effects of Federal Reserve policies, few are looking at the long-term consequences of those decisions. Schiff sees the upcoming potential rate cuts, possibly as soon as September, as a dangerous move that will only accelerate the decline of the U.S. dollar and intensify inflation. The markets seem optimistic about these cuts, pricing in some relief, but as Schiff points out, this optimism is misplaced. Rather than addressing inflation, these cuts will exacerbate the problem, especially in the context of what Schiff calls the artificial economy. Over the years, the Fed has kept interest rates artificially low, allowing cheap money to flood the market and boost growth. This created an economy built on debt, where borrowing was easy and asset prices soared. However, the day of reckoning is upon us. As interest rates rise, so does the burden of debt, and the economy that was built on this cheap money is beginning to crumble. By cutting rates now, the Fed is trying to avoid that collapse, but in doing so, it is setting the stage for much higher inflation down the road. Schiff makes a compelling argument that gold, not the CPI, is the most reliable barometer of inflation. Historically, gold has acted as a hedge against inflation and monetary instability. Even former Fed Chair Alan Greenspan admitted that he watched the price of gold to guide monetary policy. Back in his time, Greenspan claimed that if gold rose above $400 an ounce, It was a clear sign the Fed's policy was too loose. Today, with gold sitting at over $2,500 an ounce, it's clear that monetary policy is far too accommodative. The soaring price of gold is a flashing warning sign that inflation is not under control, and if the Fed proceeds with rate cuts, things are only going to get worse. In addition to gold, Schiff highlights the weakening US dollar as another indicator that the Fed's policies are misguided. The dollar has recently hit a new low, and its downward trajectory is troubling. Given that the US imports over $1 trillion worth of goods every year, a weaker dollar means that prices for these goods will rise, pushing inflation higher. The dollar's decline, along with rising gold prices, should be setting off alarm bells. But instead, policymakers are turning a blind eye to these critical signals. Schiff's broader point is that the Federal Reserve isn't cutting rates because it won the battle against inflation. It's cutting rates because it lost. The Fed's policy of cheap money has created a debt-fueled economy that cannot survive higher rates. So now it's being forced to go back to those same inflationary policies to avoid a collapse. This is not a victory, it's a surrender. The Fed is admitting that the artificial economy it helped create cannot function in a world of normalized interest rates. But instead of allowing the economy to correct itself, the Fed is doubling down on inflation, which will ultimately erode the value of the dollar even further. Schiff's insights into the history of the dollar's devaluation are perhaps the most striking part of his analysis. When the Federal Reserve was established in 1913, $20 could buy an ounce of gold. Today, that same ounce of gold costs $2,500. This means the dollar has lost more than 99% of its value in just over a century. While this may seem like a long time, Schiff argues that the next round of inflation could unfold much more quickly. He believes the dollar could lose another 90% of its value over the next decade. If that happens, the price of gold won't just be $2,500. It could easily reach $25,000 or more. In a hyperinflationary scenario, Schiff warns, the price of gold could go even higher, potentially hitting $250,000 an ounce. This may sound extreme, but history is full of examples of currencies that have collapsed overnight, from Zimbabwe to Venezuela. In these cases, gold and other tangible assets became the only stores of value that held up as the local currency lost all worth.
You know, when the Federal Reserve was first created in 1913, you only needed $20 to buy an ounce of gold. Now you need $2,500 to buy an ounce of gold. The dollar has lost more than 99% of its value ever since we turned it over to the Fed. But if you go back to when the Republic was started in 1789, when we ratified the Constitution, you needed $20 to buy an ounce of gold in 1789. And in 1913, it still was $20 to buy an ounce of gold. So our money had stable value. In fact, it increased in value. Prices were half and the dollar maintained its value, actually became more valuable. But ever since we turned it over to a central bank, the dollar's been destroyed. But I think what they did in 100 years, they may do in another 10 years. So the dollar could lose 90% of its value, not in 100 years, or but in a decade. And so what's going to happen to the price of gold in that circumstance? It's not going to be 2,500, it'd be 25,000. And that's just 90%, not 99%. Then you'd have to add another zero, 250,000. I don't know that it's going to get that bad. But if we end up with hyperinflation, it will get that bad. We just don't know yet how bad the inflation is going to be before the politicians finally and reluctantly do the right thing. But it's going to be a lot worse than it is right now. And so that means gold and silver prices are going to be much, much higher. And so people should act now to get rid of their fiat currency and buy gold and silver. Not because it's an investment, but because it's a form of savings. It's a way to protect your purchasing power. It's better than keeping your money in cash. Even if that cash pays a small amount of interest, it's still not enough to offset the inflation, so it's still a negative interest rate. And so a zero interest rate on gold is better than a negative interest rate on cash. And sometimes if you think that assets are too expensive, if the stock market is high, if real estate is overpriced, and you want to have dry powder, it's much better to keep your dry powder in gold and silver than in a fiat currency, because it's possible that when you need the dry powder, your fiat currency is going to be all wet because inflation is going to destroy it. I mean, even if asset prices come down, they may not come down in terms of dollars or euros, but they really could come down a lot in terms of gold, which is what I expect. I expect ultimately we're going to have deflation. The government is doing everything it can to prevent assets from deflating, but it won't work. Prices will deflate, just not in their fiat currencies. They can control that. They can make sure that prices always go up in the currency that they create, because that currency has no real value and they can create as much of it as they want. But what they can't prevent is prices from collapsing in terms of real money that they can't create, which would be gold and silver. And so that's what people should be holding if you are hoping to take advantage of a bargain, of a fire sale on assets, and you want to have the ability to buy them. The money you should be saving is gold and silver, because that will put you in a much better position, because you're going to see huge declines in prices measured in precious metals versus increases in fiat currencies. You know, if you look at the Dow Jones right now, it's at about 16 ounces of gold. My forecast is for the Dow to be below 2 ounces of gold. I think somewhere between 2 ounces and 1 ounce. But, you know, and that's historically precedent. You had that in 1932, you had that in 1980, 82 time frame. So I think it will happen again. It happened twice last century. And, you know, the Dow was 20 ounces of gold in 1929, and then it went to 1 ounce, 1932. It was back over 20 ounces again in 1966, and then it went back down to almost 1 ounce in 1980. We got up to 42 or 43 ounces in the year 2000. That was an all-time record high. But you know, gold over the last 23 years is up more than 8-fold, whereas the Dow was only up 4-fold. So the Dow has lost half its value priced in gold so far, you know, this century. But we're still at about 16 ounces.
For Schiff, this is why gold is not just an investment. It's a form of savings. It's a way to protect purchasing power from the ravages of inflation. While cash may pay a small amount of interest, real interest rates, adjusted for inflation, remain negative. That means holding cash is a losing proposition, as inflation slowly erodes its value. By contrast, gold may not pay interest, but it doesn't need to. Its value is intrinsic, and as inflation rises, so does gold's purchasing power. In a world where the dollar is rapidly losing value, gold becomes a safe haven. Schiff argues that holding gold is a far better strategy than keeping your wealth in fiat currency, especially if you're waiting for asset prices to correct. Even if the stock market crashes, those prices may not fall in terms of dollars. They could continue rising due to inflation. However, in terms of gold, asset prices could decline significantly. This means that if you're holding gold, you'll be in a far better position to buy those assets at a discount when the time comes. While inflation is the immediate threat, Schiff also sees deflation in the future, but not the kind most people expect. Typically, deflation refers to falling prices across the board. However, Schiff explains that while asset prices may fall in terms of gold, they are unlikely to fall in terms of fiat currency. The government will continue printing money, ensuring that nominal prices remain high, but these inflated prices won't reflect real value. And in terms of gold, they will decline significantly. This has happened before. In 1932, during the Great Depression, the Dow was worth just 1 ounce of gold. Again, in 1980, the Dow fell to just over 1 ounce of gold. Schiff believes we are heading for a similar scenario where gold will outperform other assets as the true measure of value. This revaluation will see the price of gold soar relative to stocks, real estate, and other assets. Schiff expects the Dow Jones, currently priced at around 16 ounces of gold, to fall to as low as 2 ounces of gold. This might sound far-fetched, but it's happened twice before in the last century. In 1929, the Dow was worth 20 ounces of gold, but by 1932 it had fallen to just 1 ounce. Again in 1980, the Dow was worth only about 1 ounce of gold. Schiff believes we are on track for a similar revaluation, where gold's value skyrockets relative to stocks and other assets. The most critical takeaway from Schiff's analysis is the urgency of acting now. Gold and silver aren't just investments. They are the ultimate hedges against inflation and currency collapse. As Schiff puts it, you don't buy gold to get rich, you buy gold to avoid getting poor. In other words, holding gold is a defensive move. It's about preserving wealth in the face of declining fiat currency values. For investors looking to protect themselves from inflation, Schiff recommends moving out of cash and into gold and silver. These precious metals offer a way to safeguard purchasing power, even as the dollar loses value. Moreover, they provide liquidity in a crisis. If asset prices correct sharply in terms of gold, those holding precious metals will be in the best position to take advantage of the bargains that arise. Schiff emphasizes that waiting for the perfect moment to buy gold is a mistake. The price of gold is already rising, and waiting for a better deal could mean missing out on significant gains. As inflation worsens, gold's price will only go higher, and those who delay may find themselves priced out of the market. Another important point is that gold isn't just for investors with millions of dollars. Even small investors can benefit from holding gold and silver as a hedge against inflation. Schiff recommends starting with what you can afford and gradually increasing your holdings over time. In a world where fiat currencies are losing value at an accelerating rate, even a modest investment in gold can make a significant difference. Peter Schiff's analysis is a stark reminder of the dangers of relying on fiat currencies in an inflationary environment. The Federal Reserve's policies have set the stage for a dramatic devaluation of the dollar, and the upcoming rate cuts will only accelerate that process. As the dollar loses value, gold and silver will become increasingly valuable as stores of wealth. Schiff's advice is clear. If you want to protect your purchasing power and safeguard your wealth, now is the time to move out of fiat currencies and into gold and silver. These precious metals are not just investments, they are lifeboats in a sea of inflation. As asset prices correct in terms of gold, those who hold precious metals will be in the best position to weather the storm and capitalize on future opportunities. In a world where central banks can print unlimited amounts of money, gold and silver stand as the ultimate hedges against currency devaluation. By acting now, investors can protect themselves from the worst effects of inflation and position themselves to benefit from the coming revaluation of assets in terms of real money. Gold and silver have stood the test of time as reliable stores of value, and in the inflationary storm that's brewing, they will once again prove their worth. As Schiff puts it, it's better to have dry powder in gold and silver than in fiat currency, because when the time comes to use it, your fiat currency may already be soaked. Now is the time to act before the dollar's decline accelerates and the price of gold and silver skyrockets.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.